How much life insurance you need is not a black and white area. It depends on what you're buying it for. If people are very wealthy and they're buying insurance for estate planning purposes, the amount of insurance they need may have something to do with what kind of estate tax liability they're going to have. So if they're worth $50 million and they're going to have a $15 million estate tax liability, they may want to buy $10, $15 million of insurance to cover that liability. If you're buying it more to protect your family if you die, so let's say you're the husband or wife and you're working and you make $250,000 a year, and after tax you make $150,000 a year, and you die and your family doesn't have your income anymore, how much insurance do you need? Well, some of it is based on what other assets you have. So whatever assets you already have could offset how much insurance you need. But let's use a simple scenario. I make $250,000 a year. After tax, I make $150,000. I don't really have any assets to protect my family. A lot of people think, oh, wow, I have $1 million of insurance. That sounds like a lot. But in today's interest rate environment, if I have $1 million, I'm lucky if I'm going to earn a couple of percent on my money. So if I'm only going to earn $20,000 on $1 million, but my family needed $150,000 after tax to live, then every year my wife or husband is going to be eating into that principal, and maybe over an 8 or 9 year period of time, they're going to fully deplete the death benefit, and thus how they're going to live. So today, because interest rates are so low, the amount of insurance you need is much higher because your family is going to earn a lot less money. Some rule of thumb people take is you take, your after-tax income and you multiply it by 20. So if, you have $150,000 of after-tax income, you multiply it by 20, you need $3 million of insurance. Unfortunately, in today's interest rate environment, that's probably understating your need. A 1035 exchange is when you replace one policy with another policy. And if you had surrendered the first policy, you would pay income tax. So as an example, if I paid in $250,000 of premiums over my life and the cash value is $350,000, if I got rid of the policy, I would have to pay income taxes on $100,000, the difference between the $250,000 of cash value and the $150,000 of premium. But if I replace it with another policy and I do a 1035 exchange where that $250,000 goes into the new policy, there is no income taxes at that point in time. And then it rolls up into a new policy that in the future, if I were to ever cancel it, I would still have that $150,000, which would be my premiums. And then anything above that could be subject to tax.